With low interest rates, we've seen actually equity markets push on to record highs, which has obviously been a positive for those invested in the markets. For us, I suppose the conundrum is low interest rates, that a lot of investors are invested conservatively and not able to generate a return that's strong enough to cover what they're looking to live off of. There is talk that rates are going to rise, but probably domestically not for a little time to come. Also, we've had geopolitical tension, which does lead to a bit of volatility in the markets. Even with that, we've seen record highs on markets. We've had a federal budget which has added to some of the negativity with consumer sentiment, which is holding back some business investment. The sentiment has improved back to where it sort of long-term sits around, but it's still not pushing through to businesses in terms of what they're looking to do from a growth aspect. That's also had a win for investors though by seeing dividends and relatively strong dividends through the recent reporting season and the full year results that we've seen. Obviously that's something that we want to see flip around though, that businesses get some better confidence in terms of what the growth outlook is so that they do reinvest in their business to generate longer term growth opportunities for equity investors. Another opportunity that we see obviously is China and obviously the large population that's there. There has been talk of a hard landing there, probably more so in the past than what there is in the media currently. They're going through a massive transition at the moment from what's been a big infrastructure spend towards what is now a consumption spend or getting the consumption growth picking up through the economy there. And that's being driven by wage increases and trying to push wage increases through the economy there. That for us is something that we see pushing through into a demand for authenticity, and that's something we're commenting on through the publications at the moment. Really that is pushing through, in our view, into some of the demand for takeover and M&A activity that we're seeing. So there's brands that are being poached or considered as acquisition opportunities as a result of that. Globally, markets, there's a myriad of opportunities, and some of that's tapping into still the emerging consumer growth story, which we think has still got a very long-term and structural outcome that we see as positive for investors. There's some mega cap businesses and other businesses that are expanding into emerging markets. Generally, we see emerging markets as being relatively strong growth opportunities and avenues, even though they have been rather volatile in the last few years. So from a growth or company earnings growth perspective, we see those opportunities as being something certainly worthwhile considering and something that's going to provide a different outcome to what the domestic economy is currently. So we're expecting interest rates to remain low, so that's something that we think that people are probably taking on a little bit extra risk in some areas. So it's realising that in a lower interest rate environment that you're going to get a lower return. They will start to rise at some point in time, but certainly not in the near term. We see some volatility coming into markets, obviously with some of the geopolitical tensions pushing through and people starting to question valuations and when rates will rise. So that's a bit of a risk as well that we see. But generally, obviously, we're a long-term house, so we aim to keep people focused on the long term and remove themselves from the noise, which is a key to long-term investing.